go. Thanks, Emily. So today's plan is gambling from 1:10, roughly 1:12, to right up 2 o'clock, and then from 2 to 2:50, we're going to do disaster losses. If you have to ditch before disaster losses, make sure you read the first couple of pages in your handout, because there's some information about claiming disaster losses, which some people are not familiar with. And it has to do, I don't want to spoil the surprise, but it has to do with whether or not your client is eligible to ignore the 10% AGI limitation on casualty disaster losses. So if you're not familiar with that and you have to leave early, be sure you catch that in our handout. But let's start with gambling winnings and losses for today. And we did have a little change on that with OBA. I've got a typo here. So the bill that was passed in July did have a change to gambling losses, which doesn't start until 26. So this won't affect anybody in 25, and this, I've actually, once the bill got passed, we were all taking as many webinars as we could to see what was going on, and I've heard this misstated several times. So I want to make sure everybody's clear. Starting in 26, a lot of our clients are still going to be able to take the full deduction that technically wipes out their gambling winnings, because the 90% permitted is on their losses. So for example, if somebody, let's say, has a $2,500 W-2G and their gambling losses that they're able to substantiate for the year is $3,000, if you reduce that to 90%, then they get $2,700 of gambling losses on their Schedule A against their $2,500 W-2G on Schedule 1. They're still getting to write off, in theory, a deduction against their entire W-2G in that example. Now, what we're going to talk about here is how being forced to report your gambling winnings on Schedule 1, line 8, raises your AGI, and we have many, many clients that either don't itemize at all, or let's say they're only itemizing by a few $1,000s, and they may be losing a substantial benefit even if they itemize to some of their total 90% of their gambling losses. So we'll talk about the the way gambling losses get deducted is very painful for a lot of our clients anyway. But to just confirm, what is the change for 26 is that only 90% of gambling wagering losses are deductible, and then again up to gambling winnings. And those are, we're going to talk about also the same session gambling losses today. And there's some misconceptions about that also, that maybe only professional gamblers can do that, not recreational gamblers. So we'll talk about that also. The bill that basically held this provision for the gambling losses are only deductible up to 90% of the documented losses was quiet on same session losses. And so we're assuming that that applies to same session losses until we get more guidance. And as I mentioned, this provision was misunderstood by some people. And this 90% loss limitation is also going to apply to professional gamblers, and we'll talk about that also. We've actually got an interesting court case on professional gamblers that lost their court case, and one of the spouses was actually an accountant. And the court didn't seem to like her record keeping very much, especially in light of the fact that she was actually an accountant. So they kind of held her to a little bit higher standard with her court case, and she lost her professional gambling court case. In any event, okay, so tax matters for recreational gamblers. So those are our friends, family members, our clients that go to the casino once in a while, or the racetrack or whatever, or their sports betting parlor or whatever, and they're just recreationally gambling, okay? So as we've mentioned, winnings in those instances, they raise our AGI, okay? It goes on Schedule 1, line 8. And so not only does it raise our AGI, but then that may affect things like our $25,000 rental loss exception. It may affect someone's ability, for example, to get the tuition credit, perhaps for their children in college or something like that. For this last year where somebody could have bought an electric vehicle, potentially, that could also potentially impact somebody's their $7,500, for example, automobile credit. So there's a lot of pain that can come with the fact that gambling winnings raise AGI, okay? And so even if the gambling losses can completely zero out the W2G, that would be on the Schedule A, and that's below AGI, which causes a problem. So as we mentioned before, some taxpayers don't itemize at all, and then other taxpayers are only over the itemized threshold a little bit, in which case they may not get the full benefit of all their gambling losses. And remember, for 25, they still can take 100% of their substantiated gambling losses. Now, so for gambling for recreation or entertainment, it's all gambling winnings. Lottery, raffles, if somebody wins like a lump sum payout, somebody may take installment payments if they win a larger prize or some type of a raffle or something like that. And then, by the way, occasionally someone will get a prize that's going to be paid out over a period of time, and they sell their right to receive those future lottery payments. So if someone ever does win a prize that's to be paid out over multiple tax years, and they sell their right to, like they take a discount, they get their cash up front, when they sell the right to receive the future benefits, that's all taxable in the year that they receive that money if they chose to go that route. So where our gambling income is reported is Schedule 1, Part 1, Line 8B, Other Income, and it says gambling right on it. And then, generally, they're going to receive the W2G, which we're familiar with, some prizes, which would be sometimes like a radio contest, or let's say a contest at a state fair or something like that, that has reportable winnings. They might be in 1099 miscellaneous box 3 instead of a W2G. So here is our 1040 Schedule 1, and there we go at the very bottom of the slide, our 8B gambling. So I don't know how many of you remember back Tax Cuts and Jobs Act, we were going to have the postcard. And then we didn't end up with a postcard. We ended up with Schedule 1, 2, and 3. And in case you're not aware of this, the reason they wanted to do away with things like line 20, where you just put this laundry list of other income, is they're really building up algorithms to know specifically what's in every single tax return, and then be able to go line up the other information on the return, for example. And if you haven't seen the 1040 for 25 yet, again, they've added a few more lines having actually nothing to do with OBA even. They've added a few more lines to split out other things. I think one of them is the dependent care benefits now is a separately stated line, when it used to be just a little memo and put on the wage line if somebody had dependent care benefits and they didn't have enough child care to absorb that. So you're going to find when you see the 25-1040, they're even putting more detail. And some of the detail that they're basically forcing on all these 1040 schedules seems so minuscule. It's like, this is ridiculous. But the more that they want to leverage formulas and leverage algorithms, it really, what did Frank mention earlier? Oh, no, it was LG mentioned, what was it, a contactless audit, for example, you mentioned this morning? So they're going to be doing more and more. And this is even not counting any AI issues. This is just build algorithms that are evaluating all these things on a tax return to then potentially evaluate, let's say, risk or issues, or to generate perhaps letters. So we're going to see a lot more of that, which is why we've now got Schedule 1, which has been substantially expanded. Okay, now, so generally gambling winnings are subject to information reporting based on the organization that is, holding either, they're either providing gambling for recreation or entertainment, or they're holding a little raffle or something like that. So generally, W2G is required for a slot machine winning of $1,200 or more, $1,200 or more of a win at bingo, $1,500 or more at Keno, And also $600 or more, that's generally the 1099 miss, box 3, for things like sweepstakes, lotteries, sporting events. And sometimes they use little formulas that if the win was more than 300 times the amount of the wager, that may create a filing requirement for the organization. Every once in a while, we may be contacted by, let's say, a nonprofit that we do their taxes, and they may ask us, hey, what are our rules if we're going to have a little raffle or we're going to have a little contest? But other than that, generally, as the tax practitioner, we don't have to get too involved in what are these reporting requirements, because what we're doing is consuming the W-2Gs and the 1099 miscellaneous that our clients are bringing us. Now, I do have some colleagues that if somebody shows up with 17 W-2Gs, my colleagues enter every single one of those W-2Gs. I am not in that camp. I am in the camp of the EIN for the establishment and the Social Security number for which spouse it is. And if there's 17 W-2Gs and 9 are the taxpayers and 8 are the spouses, and let's say there are 2 different establishments, 2 different casinos, because we've got about half a dozen Indian casinos in San Diego County, I'll lump them all. These are 6 for the taxpayer at Verona, for example. And even with withholding, you can lump those together and get them in your little W-2 worksheet in your software, and you're not going to have a matching problem. What I wouldn't do necessarily, if there's withholding, I probably wouldn't combine EINs. But I know some people that ignore the W-2G worksheet altogether, and they put a total on the Schedule 1, line 8 for taxpayer and spouse, and away they go. I think if there's withholding, we should at least get the EIN, even if we're lumping several W-2Gs with withholding. But don't feel the need to enter every single W-2G as a separate document. There's no requirement for that, and you won't cause any kind of matching letter. Now, the other thing that the W-2Gs often do is identify the type of gaming activity, which is it slots versus Keno or something like that. Again, I haven't had any problem netting those for one taxpayer or the taxpayer and the spouse. And then again, even if there's withholding, you're generally not going to have a problem if you net multiple W-2Gs for the same Social Security number in the same establishment or EIN. Okay, now, so reporting lotteries and raffle winnings, as we mentioned. So this may be in addition to cash winnings. Years ago, I worked with a lady who won the garage door at the state fair. She won an enormous, Ford SUV, brand new. She won a huge set of golf clubs. She won a big barbecue. She won a spa. It was all in this one huge prize. Her whatever opened the magic garage door. And we were all just cracking up all summer as she was making deals to sell all, she didn't golf. What the heck am I going to do with these golf clubs? So anyway, so just be aware. And I've actually had a client that won a house in a raffle in Arizona. Won a house, an entire house. So generally with something that big, there's going to be an appraisal. That's your fair market value type thing. Generally that would be reported on the statement. But if you have a client that wins personal property that's not specifically cash, there is definitely, there's where we're going to report those winnings on Schedule 1. And if they feel that they didn't receive the 100% retail price of that item, and they keep their documentation of what they really were able to sell the item for. And I would be careful. I'm like, well, I sold it to my brother for $500 and maybe the fair market value is $5,000, probably wouldn't fly. But if it's an arm's length transaction and you keep good records, I wouldn't hesitate to make an adjustment on the Schedule 1 if somebody wins personal property and they end up selling it for less than was reported in the dollar amount. On however that was reported. I'm pretty sure hers was 1099 miss. Okay, now, in this case, as I mentioned, we want to document the reduced value, how it was arrived at, and then we want to put the adjustment on Schedule 1, Part 2, line 24Z. So, but just be aware, I've had lots of clients win items that were not cash. And then, as we mentioned before, If someone wins a prize or a lottery that's to be paid in installment payments, there oftentimes that will come with taxable income in each, taxable interest in each year they're paid, depending on what the contract originally was when they won it. Also, be careful with state-fed differences. There are some California lottery prizes, for example, that are taxable for federal but not California, but the interest potentially would be taxable for both. So we need to be careful of that. And then, as we mentioned, if a taxpayer sells their future lottery payments for a lump sum, we're going to report that on line 8B. And oftentimes, that if they sell the future benefits for a lump sum, there may not be a reporting document that year. So we may have to be careful that we're aware of what's occurring and that we get that lump sum put on their Schedule 1. And again, that's just something we would inquire each year. If somebody won something, let's say to be paid out over 10 years, did you get your year 3 installment this year? Oh no, I sold the whole contract. Okay, well that's going to escalate the tax on those winnings. Okay, now we've talked about putting our winnings on Schedule 1, line 8B, but there's also several cases where we may have to back it out on 24Z. And as I mentioned, one already is if they win personal property and there may be an adjustment to the value that they actually received. And I think I've got a couple more so I don't get ahead of myself. Yes, here we go. So another one would be same session losses. And we're going to definitely talk about same session losses as a back out. But you may also have a client that feels that they have a bona fide trade or business of gambling. Could be maybe a professional poker player. There are some people that do believe they are professional slot machine players. And we're going to talk about that court case. So what happens in these cases is even if someone's a professional gambler, especially if they play a lot of slot tournaments, they could get an enormous amount of W-2G income, but it all rightfully, assuming that it's a bona fide trade or business, belongs on Schedule C. So you may end up with a situation where you've got an enormous amount of winnings on Schedule 1 for a professional slot machine player, and you're backing the entire thing out on 24Z because you're reporting it on Schedule C. And then we're also going to look at a form a little bit later, which is called 5754. This is a form when there's a prize or winnings in your Social Security number or the taxpayer's Social Security number, and they are splitting the winnings. This would be the case of, for example, let's say everybody in a certain office, they all go in on lottery tickets together, and then the winnings are reported under one person's Social Security number, but they're really splitting the prize, for example. So there's actually a specific form that you can file to make sure that your client isn't hit with the tax on something that they had to share. Okay, and we'll talk about each one of these things as we go. And so as we mentioned before, for our recreational gamblers, their losses are going to go on Schedule A, line 16. And most of us are aware that it doesn't have anything to do with the 2% floor or any of those miscellaneous itemized deductions. And again, for our recreational gamblers, this would be after we net our same session winnings, and we'll talk about that in a minute, if applicable, okay? And most of our software, even if Schedule 1 didn't have a special line now for gambling, which it did, most of our software for years before Schedule 1 got more detailed had a special field, that we would put gambling winnings in our software, and then when we put gambling losses in our Schedule A, our software would throw an error or raise a red flag saying, hey, you put more gambling losses here than you reported over here on your little worksheet. And that's, by the way, something the IRS, the other reason they want all these lines, so they could run their own little algorithms. But in any event, so this is how we're going to report our gambling losses for recreational gamblers. So if you're not familiar with what is called reporting net session gambling winnings, what it is, and we've got a couple of examples to go through, and we've got a great deal of IRS guidance that's been published on this. You're permitted to, let's say someone takes $500 to the casino one day, and let's say they win a $2,000 jackpot. I can't do the math, but let's say they ultimately leave with $1,700. They brought 5, they won 2. That's $2,500. So if they leave the building with $1,700, they've basically spent $800 and they brought 5 with them. So you're allowed to literally say, during this period that I won this $2,000, I also spent money gambling. So you put the $2,000 W2G on the Schedule 1, Line 8B, and the amount they lost that day related to that same session. And we're going to talk about what the IRS thinks a session is, because it gets a little detailed. But you can subtract that on line 24 and 24Z, excuse me, and therefore reduce the hit to somebody's AGI for those gambling winnings. And this is very beneficial, especially for people that don't itemize or that aren't getting a full benefit of itemizing. And so we have IRS notice 2015-21, and this guidance specifically confirmed the applicability of netting same-day wins and losses, and it also provided a safe harbor specifically to track slot machine play. Now, this specific notice, and I think even the chief counsel advice that came out related to this, only discussed slot machine play. But most people in the tax world have said, okay, if that's a reasonable interpretation of same session, I'm also going to apply those same IRS regulations to Keno or to some other type of betting, let's say blackjack or poker. So I think, and there seems to be kind of widespread adoption of that. Even though the guidance offered a safe harbor for slot machine play, everybody feels pretty comfortable that it's a legitimate way to report to net the gambling winnings and losses in a day, as long as we stay within the parameters of what the guidance permits, okay? Now, we're going to talk a little bit later on, too, about what you're going to find, which is conflicting IRS guidance on some of the rules we're talking about today. And I've actually got some examples in your handout and on the slides. But specifically, this netting of gambling winnings and losses in the same, what they call session, does not apply to anything called non-wagering expenses. So for example, if I fly into Las Vegas and my airfare costs $500, that isn't part of my cost of gambling that day. You're only allowed to net what they call wagering costs, okay, specifically wagering costs. Even though you are going to find IRS guidance in pubs and things that even tell a recreational gambler, by the way, you have to pay taxes on your gambling winnings after your travel costs. And that has not been true for quite a while, at least as far back as Tax Cuts and Jobs Act, and you will still find that in IRS publications today. So here's our IRS notice, 2015-21. And again, they specifically use slot machines as their example. Reportable gross income from slot machines is determined on a session-by-session basis. A session of play begins when the first wager is placed on a particular type of game and ends when the same person, so spouses can't merge, spouses' transactions stand alone for each day or each session, ends when the same person completes the last wager on the same type of game before midnight the same calendar day. Now, I want to bring up this bullet point number 3. There are many tax educators that honestly believe that it's acceptable to pick a 24-hour period. If it might, like noon to noon rather than midnight to midnight, the guidance that has been put out is actually quiet on whether it has to be calendar day to calendar day. The most narrow or conservative approach would be literally midnight to midnight. But I know some people that are huge advocates for consistent 24-hour periods. So, and if you think about some night owls, some people, they don't quit gambling at midnight. They quit gambling at 2 or 3 in the morning, and so they may want a different 24-hour period. You're going to have to decide your level of comfort. But in this example, because we're using a consistent 24-hour period, and we're kind of trying to go to the letter of the IRS notice, and this is from the IRS, a session of play is always determined by a calendar day, a 24-hour period from 12 a.m. through 11:59 that day, and ends no later than the end of that calendar day. They actually have some verbiage like that in some of the IRS guidance on same session. So you can decide your level of comfort of saying, I'm picking a different 24-hour period. But I wouldn't, especially in the same trip or something, I wouldn't go, well, this day was 3 to 3, but the next day was 8 to, I wouldn't go there because I don't think you're going to win that in the event of an exam. Okay, now again, from the verbiage of the IRS guidance, it also states, leaving one establishment and beginning slot play at another establishment starts a separate session. So if somebody's at the Flamingo in Las Vegas, 9 o'clock in the morning, and at 2 o'clock that afternoon, they walk across the street and they go to Caesars, guess what? That's a second session of play, even though it's in the same 24-hour period, okay? And then again, as we already mentioned, for married taxpayers, the notice specifically refers to a patron or a taxpayer. So we definitely do not want to net spouses' activity. And we've got an example from the IRS about spouses that should help. So if we want to take advantage of this, which is very favorable for many clients, even clients that can use all the losses and benefit from all the losses on their Schedule A, they may still benefit from reducing their AGI with this process. So we're going to report our gambling winnings on Schedule 1, line 8B, and we're going to report our same session losses, Schedule 1, Part 2, 24Z. I'm going to tell you something about this. I've actually had a client. Oh, did you have a question?
Does this need to be substantiated by a readout from the gambling place?
They recommend that. The guidance does say that one way to substantiate this is to use your rewards program. But some people don't use a rewards program. I have a friend of mine that loves to gamble. She gambles like crazy. And she's absolutely convinced that she's got the trick and that whenever she's having a lull in her winnings, she doesn't use her card because they won't know it's me. And they're going to think I'm a brand new gambler and they're going to want me to win so they can get me hooked. I mean, she's got this whole scenario in her head why she quits using her card because it changes her luck. So for various reasons, not all of our clients have the reward statement.
Only apply to slots, not to table games?
Okay, so the guidance that we have a chief counsel advice and we have a notice. And both of them only mention slots. The notice just mentions slots and mentions a safe harbor for slots. And the chief counsel advice only mentions slots because the inquiry from the taxpayer was related to that notice. But the general consensus is if you stay within the parameters of the same session and what a session is and what a calendar day is and all that, that you're probably fairly safe using it, for example, poker or Keno or bingo or something else like that. But one thing I do want to caution you, I have had a friend of mine actually did the same session netting on someone's tax return, and they got a letter going, baloney, you owe the money. And she had to mail the letter back to the IRS, and she quoted the little notice, blah, blah, blah. And they got another letter going, you can't deduct this. And so she literally had to send 2 replies. And she finally took a photocopy of the notice and stapled it to her second letter. And finally, here comes the letter going, okay, you're right. So you've just got to, just because this gets denied the first time doesn't mean it's wrong. It's because you don't know the level of experience of who is handling, who's handling the algorithms when they get spit out, right? And by the way, the notice specifically tells you what to put on the line. It actually, because this was, I think, a temporary notice that was never finalized, it actually, and I've got the verbiage in your handout and on a slide, it actually says put notice 2015-X. And it tells you to use -X because it was never made permanent. And so they actually, in the guidance, tell you what to put on that line. And she put the exact verbiage that the IRS, and I won't say instructions because the instructions are extremely light on this, which is they don't mention it at all, if you look at the instructions for Schedule 1. But in any event, she used the exact verbiage you were, and it still got kicked out by the IRS, and she had to argue with them. Okay, now, so, yes, sir. Oh,
I had an audit on this, and after bitching back and forth, he gave in, the auditor, comes back to me and says, don't ever do that again on another tax return, you won't win next time. Can you believe it?
it's, I don't, that's the nerve kind of, right? Yeah. But yeah, did you have a question?
Yeah. So you got the readout from the casino, so you're putting it on one, but you also have a W-2G. So should you enter that somewhere and say,
So,
like this on
no. It's not that complicated. For a recreational gambler, and we're going to talk about how some professional gamblers got in trouble because they felt only their winnings were W-2Gs. So for a recreational gambler, it's just the W-2G. You're using the reward statement of the in and outs, right? You're using that to substantiate their losses for the session. You're not putting a gross amount of all the winnings. You're only reporting their W-2Gs.
Right, but if during the session, so you get the total winnings, the total losses, and those are the numbers you're gonna put on 1 and 24, those are the numbers you're gonna put on there. But now you've got a W-2G because in that session, they reported the one big jam.
Again, don't report the winnings off the reward statement. Only report the W-2Gs. I don't know how else to say that. That's all you're doing is reporting the W-2G. What you're going to use, and then I would also have, and I may be using the reward statement to show what they bet, okay? But you got to understand, some of their betting was done by what they also won, right? You need to know what cash did they take to the casino, what did they have in their pocket when at midnight or when that session ended, right? And so you're not reporting the winnings off the reward statement. You're reporting the W-2Gs, and you're using the reward statement to substantiate their losses, okay? And substantiate their period of play, okay? That's what you're doing. Don't try to pull all the winnings off it wouldn't work, in my opinion, and the IRS isn't looking for that. But in any event, okay, so this is from our chief counsel advice. Did you have a question?
So if you put the W-2G and it's $5,000, but in that session they lost $10,000, you could put that on the.
Well, not in excess of winnings. So yeah, so you would put 5,000, absolutely. Yeah, if somebody walks in the door with $1,000 in their pocket, they win 5,000, and by the time they leave at 11 o'clock, and they've already borrowed $500 from their buddy because they've blown $6,000, their losses are the $5,000, right? Because your losses are limited to your winnings, okay? Even next year when it's 90% of losses, it's still limited to the winnings. Yeah. Okay. And even professional gamblers now cannot run their Schedule C in the red at all. Even with bona fide business expenses. But in any event, okay, so here's our chief counsel advice. And again, we have this in your handout. So, and this chief counsel advice specifically requested assistance about what they called a recurring issue. And by the way, they actually say in the chief counsel advice, you can't cite this as precedent. But it said, such reported payments are, and everything in italics I'm quoting, okay? Such reported payments are not necessarily taxable wagering gains, okay? And then it goes on to say a gambling business may issue an information return for a casual gambler's winning spin, so that's my jackpot I won, but the gambler continues to play and wagers and loses that amount during slot machine play. So and this is from the chief counsel advice, wagering gain or loss is determined at the time the casual gambler redeems his or her tokens at the end of slot machine play. So that's right from the chief counsel advice that's kind of blessing same session netting. Now, and then here's the notice right here. And then we also have an advice memo that went back to 2008. And by the way, I don't know if this is true and I don't want to spread rumors, but I heard years ago that one of the original court cases, and I don't think it's this fella, because I heard that there was a Chinese citizen that would come into actually San Diego County and go to the Indian casinos And because he's not a resident or a citizen, he was filing an NR, didn't itemize. And evidently his attorneys, I guess he won big, one trip. His attorneys went to court and said, you know, based on how we're reading the tax code, he should be able to reduce his big jackpots while he was in town by what he spent gambling that day. And that was evidently a court case that started a lot of people becoming aware, for example, of the same session losses. It was kind of interesting. So in any event, so here's our notice. It doesn't discuss anything else. It doesn't discuss horse racing, other casino games, craps, roulette, anything like that. But other wins and losses refer to ascension to wealth, and for session, so how much did they really win? So what the comment here is both the IRS notice and the memo and the chief counsel advice talk about the netting of wins and losses as how much did they really gain, okay? So again, most educators are on board with the fact we can apply the same rules in those notices to other gaming transactions, okay? And then they do cite another court case that says, the court said it's impractical to record each separate roll of the dice or spin of the wheel. And again, they were talking about a netting thing. Now, here is their example for a married couple. So Gambling Gary, you can tell I know Ryan. He's the gambler. He loves, what do they call it, alliterations. Gambling Gary and spouse Chris stay at the Riverside Casino. They check in at 11 a.m. Tuesday, and they start playing slot machines at 11:20. Okay, and then I'm not going to read through this whole example in the interest of time because I want to get to professional gamblers. But it basically goes on to say that Gary spends $900 on slots and he wins $1,300, okay? And he's got a W-2G for his $1,300. And then he had $600 in cash when he started playing, and he had $1,000 left over for tips, drinks, snacks, and cash to go use at Keno, okay? And his slot wagers are shown on his gambling rewards statement for each calendar day of play, okay? Gary also played $150 on Keno that day, and he won $220. However, Chris, the spouse, won big on Keno. He wagered the same amount as Gary, but Chris won $2,000. But Chris can only net what he spent on Keno against his $2,000 Keno. For example, if Chris had lost some money on slots during the same day, can't net it, right? And so that's what they're trying to clarify here. They also talk about, at the bottom here, they never left that one casino. They stayed there all day because had they left and gone to another casino, it would have started another session. And then it goes on, we describe here, and again, I don't want to read it line for line in the interest of time. Oh, here, I did want to point this out, though. The first bullet point, they're going to report on line 24Z, revenue procedure 2015X, and that's actually in the guidance because that revenue procedure was never finalized for whatever reason. And then because Gary's Keno losses exceed his wins, and Chris's slot losses exceed his wins, those losses are not allowed to be reported on Schedule 1. They are completely lost in the cases where the type of games, but they could potentially take some of the extra losses as an itemized deduction. Okay, now, and then we're going to talk about keep an accurate log, and a lot of people like to go to even if they don't want to use the ATM at the casino because the fees are high, they will still go to their regular bank ATM on their way out of town or something like that, just to keep a record of what cash they had available. I think Tom Grzinski tells people to take a picture, put all your money on the dresser, snap a photo, that's what you took to the casino, as good as any, right? And then we have some information here. If we are keeping a gambling log, it should specify the type of wager, what was the name of the establishment, who we were gambling with, what do we win and lose, and all those fun things. And then it says tax liability from gaming depends on the facts and circumstances. So again, we've got some different information here about how would we substantiate our Keno losses. We might keep copies of all our tickets. Slot machines, we might use our rewards program. table games. You know, they talk about different ways we could substantiate those losses. Again, I'm not going to run through all of those. What I want to talk about is it's extremely challenging to explain this to clients. Somebody's going to give you 2 or 3 W-2Gs that total $5,700, and then you're going to go back and try to get them to explain to you for their 2 trips to Las Vegas this year or whatever, what they actually spent each day. And I've had clients like get mad at me because I'm bothering them. And I've had to pick up the phone and go, look, I think I could save you some money, but I'm not making these numbers up. Sit down, try to figure this out, try to do this, and now I'm educating you, and so next year, please keep better records. But sometimes the most painful part about same session is literally convincing the client. Now, I want to talk about timing activities, and then I want to scoot over to professional gambling. Here's what's painful about somebody who travels and vacations, gambles on vacation. This is a tax year, right? So what if somebody, they win a big, for example, W-2G, let's say New Year's Eve or something, and even if they could itemize, okay, let's say they're going to blow a lot of money on this trip gambling, they may be spending money on New Year's Day and January 2nd, and even with itemized deductions, they can't take the rest of their losses for that trip against the big jackpot they won New Year's Eve. So we've also got to be careful, in addition to same session netting, then we have recreational gamblers that are, again, going on a holiday over the new year. They may end up with a situation where a lot of their gambling losses are the first few days of the new year, and they can't even use those as itemized deductions against a big win. So we just need to keep that in mind. So let's talk about professional gamblers. Oh, by the way, professional gamblers do not need to worry about same session netting at all. The only reason that I would kind of maybe have some records that might support same session is in the event that they actually have their Schedule C challenged and they lose that, their recourse may be, well, now I'm going to amend and do same session. But if you think about if a Schedule C gambler is, like a professional gambler, is allowed to deduct not only their wagering costs, but their bona fide business expenses, there is no need to worry about same session specifically. But the other thing we have to be careful about for professional gamblers is things like SE tax, for example. And we've got to worry, now they're potentially eligible for QBI. They may be able to deduct their self-employed health insurance. They may be able to fund a pension, right? Or an IRA with those wins. But what we want to be aware of, and then don't forget, for a professional gambler, if we're reporting these winnings on Schedule C, we're going to have to back the W-2Gs out of Schedule 1. Now, this is our change that came about in Tax Cuts and Jobs Act, and OBA basically doubled down on this. You're not allowed to run a Schedule C for a professional gambler, whether it's poker or whatever it is. You can't run the Schedule C in the red. So you can, if your wagering costs don't exceed your winnings, and you have some bona fide business expenses, maybe travel, maybe home office, maybe something like that, you may take those expenses up to the profit of the Schedule C, but that would be it. You can't run it in the red. And then here we go. This is the verbiage of the Section 165D that was set up that said this ends January 1/26, and then OBA extended it, okay? And so here's the verbiage from OBA that went on to talk about, so even professional gamblers are limited to 90% of their bona fide costs, even their deductible business expenses under 162. So kind of painful. The other problem where people get in trouble with specifically with saying they're professional gamblers. So what if somebody just is really, they gamble a lot, they're retired, they've got the funds, they gamble a lot, and they do pretty well, and so they're like, gee, we can't deduct our travel and our classes we took to become good poker players or whatever, and our lodging and all those expenses. But if we were professional gamblers, we could, even if it's only up to winnings, but then they get to kind of zero out their winnings, and their theory is they're kind of subsidizing their vacations, right, by saying they're professional gamblers. The problem is, you've got to really treat it like a business. And one of the things, I guess, that trips up a lot of professional gamblers is recreational gamblers report W2G. Professional gamblers are supposed to literally report every single time they win. Now, and I don't mean every, pull of the machine or every single poker game, but where people are losing professional gambling in court cases is that if they're like, if this was any other business, you wouldn't be just reporting income somebody 99'd you, reporting your gross receipts. So you, as a professional gambling business, what records are you keeping to say this 3-day trip to Las Vegas, my gross receipts were X, my wagering costs were Y, and by the way, these are my travel costs or my other bona fide business expenses. And that's where people are getting in trouble in tax court, is because professional gamblers are only reporting their W2Gs. And this is the case. Susan Mercier versus the commissioner, and she's the one that was the accountant. And they felt that an accountant should understand the concept of gross receipts. And they felt that they could really substantiate. They only ever played video poker. They could prove they had a system that they developed over many, many years. They never played any other game ever. And they didn't play ever for recreation. To them, it was 100% a bona fide, consistent for the purpose of making money, et cetera, et cetera. And they lost simply because they didn't feel they were keeping adequate business records, and she wasn't reporting gross receipts. So they felt that they weren't meeting business standards. I'm going to scoot along because we only have 2 minutes. We've got some information in your handout about specifically hobby loss rules that would catch some of our clients that seem to feel they are professional gamblers. And we've got some, again, hobby loss rules, which I'm not going to go into. And by the way, someone can be a bona fide professional gambler and still only do it part-time. That's not the designation about whether or not someone's a professional gambler does not really have to do about how much time they spend, but it's kind of how they are structuring this bona fide business activity, for example. And so we've got some more. Now, here's what I mentioned earlier, the conflicting IRS guidance. You are going to find instructions that, like for Schedule 1 and Schedule A, that don't mention one thing about same-session netting at all. You're going to find guidance in the IRS that says things like, don't forget to deduct your travel costs when you're calculating your gambling losses. And so be very careful that you're familiar with the Chief Counsel advice and the IRS notice we talked about. And I would even consider looking at that reference for OBA. But even the OBA provision about this 90% of gambling losses was totally quiet on same session, totally. And so again, here's more of, this is a pub. This is a pub that I don't think they've revised it yet still, that still has, discusses losses include actual cost of wagers plus expenses incurred in connection with the conduct of the activity, such as travel to and from a casino. Absolutely not true after Tax Cuts and Jobs Act, and that was still in IRS published guidance a few months ago. So anyway, keep those in mind. I wanted to scoot over to, again, Pub 529 doesn't mention same session netting at all. Completely quiet on it. And then, by the way, it does, however, mention that professional gamblers might be eligible for a home office. So a home office can't run a Schedule C in the red anyway, but if they have a bona fide home office and they have a bona fide business, they may be able to still reduce their taxable income on their Schedule C with a bona fide home office. This is the form I mentioned if we want to allocate a group of people that win one prize together that they're sharing. That's the 5754. And then we've got some information on reporting gambling winnings for non-resident aliens. And we do have some information on Pub 519. Remember, that was the court case of the Chinese citizen that challenged the same session. And then I've got a list of different resources for you here from the Internal Revenue Service. So we are 1 minute late to start disaster losses. So, I don't know how to get my person's gone. Let me pretend I know what I'm doing, which is always a stretch. Yay! We have to open our other slide, I'm sorry. I closed it, so it's probably down there in the thingy. remember, if you have to leave early, at least read the first couple pages of disasters. There we go. Perfect. Thank you. Okay. So briefly, so talk about disaster losses. There were a couple changes with disaster losses, specifically under OBA. And that matters a great deal because it did what I called rolled the dates. Rolling the dates. You know what? Let me start with this most critical piece so that most people can get it if they have to leave. Here's what a lot of people don't understand about disaster losses. We have had for the past many years now, you can only ignore the 10% AGI deduction for a casualty loss, a disaster casualty loss, if the disaster that your client has experienced is within the last time the federal government did what I call rolled the dates. And the example I'm going to give you is this. Those horrible floods in Texas when all those people died. That event was deemed to have started something like July 2nd. The bill was signed July 4th. If those floods had started July 5th, those people to this day would be subject to 10% AGI until the next time we pass another disaster bill. And so I'm going to talk about what the heck I'm talking about so you understand it. But just be aware, if you've got some clients that have suffered some substantial casualty losses based on a federal disaster, and they have a situation where the disaster dates have not been extended lately by Congress, okay, it's specifically by Congress, you may have a situation where you're filing a tax return for someone and they're subject to the 10% AGI limitation, and then the bill finally gets passed 18 months later. Now you get to amend and get them more money back because now they're not subject. And so a lot of people don't understand this, that the 10% AGI limitation is literally 100% dependent upon the last time we have passed a disaster bill. So the last disaster bill before OBA was in December of 24. It was literally 2.5 pages. And the reason it was 2.5 pages is because all it did was talk about making some disaster payments tax-free, which we'll talk about in a minute, but it was responsible for doing one thing and one thing only, extending those dates. And until that bill was passed in December of 24, all those hurricanes that affected 9 states on the East Coast, Florida, I think it was Milton and Helene, all those hurricanes, those people that were all subject to those disasters were all subject to the 10% AGI until this bill was passed December 12th of 24. And this is a huge problem for practitioners and taxpayers, some of which suffer substantial financial hits during these disasters, and they're really depending upon being able to generate refunds and that type of thing. And many of them are blocked by that simply because they're stuck with 10% AGI until the next bill gets extended. And so we had December 12th, and then the next bill came out in OBA. They purposely rolled those dates in OBA because who knows when they're going to pass another one, right? And so that's what we have to keep in mind of how that works. So I'm going to go ahead and stay in the order of my slides, and I'm going to talk about specifically how you are aware of what federal deduction your client is eligible for. And another thing OBA did is it now said the current administration does not like FEMA at all. So they're trying to make bona fide deductible disasters being declared by a governor, and they want some of the states to accommodate more of the costs that to help reimburse people that are subject to these bad disasters. The problem is our federal tax code only allows the highest federal deduction, which is you get to ignore AGI, for a federally declared disaster. So I think they're going to have to modify the next disaster bill. It's all well and good to say, okay, I've got a deductible casualty loss because my governor declared a disaster, but I can't ignore my 10% AGI because the president didn't declare my disaster, only my governor did. So we've got some nuances that we've got to be familiar with, even with the new OBA bill. So specifically, what OBA did is it replaces the references to the Taxpayer Certainty and Disaster Relief Act of 2020, and it basically says all the dates in the 2020 disaster bill, we're rolling them all now. And now, so for example, when that bill got passed on July 4th, anybody who has a disaster that ended later than August 3rd, they're now stuck with 10% AGI until there's a new bill. That's literally how it works, and it's kind of crazy. And I've got some examples to walk through that'll make that more clear. But so to help you here with, so what happens is once the bill gets passed, once the latest disaster bill gets passed, whether it was the standalone bill in December of 24 or whether it was a little provision in OBA, okay, this is what happens is whenever they, what they call roll the dates, you can ignore 10% AGI if there's a disaster declared no later than 60 days after enactment. So OBA was July 4, 25. So 60 days, not 2 months, but 60 days from that date. If there was a disaster declared within that 60-day period, then that could be what we call a qualified disaster. If it's 61 days after that bill, they're stuck with 10% AGI until there's a new bill. Then it also has to have an incident period, which began on or after the date of enactment. That's why I said with the Texas floods, if their incident period had started July 5th, those people would be subject to the 10% AGI. And then they have to have an incident period which ends no later than 30 days. And by the way, you don't have to guess when the incident periods are. If you go to the and I've got this information on a couple slides. If we go to the IRS disaster webpage and we go down to our state and the disaster we're checking on, when we go to the FEMA link for each of these specified disasters, the FEMA link, the very first thing when you hit the FEMA page says, incident began, incident ended. So you don't have to guess at what these dates are. This information is absolutely available to us, kind of at our fingertips. It's the interaction with the last disaster bill that becomes painful. So this was the bill that extended the dates right before OBA. And this bill had a couple of other important issues. And it basically said that anybody who received a qualified wildfire relief payment wouldn't owe tax on it. And the reason this matters, and we're going to talk about this when we talk about the nuance of whether we can ignore the 10% AGI, but someone may actually have a taxable casualty loss, okay? And this can happen especially with something like somebody with a basis in their home that's destroyed, and their basis in their home may be super low, and they may get an enormous insurance payout based on replacement costs, or they get some other funds from, let's say, a wildfire. Like California has wildfire funds to help the public, for example. Or occasionally you'll have, for example, in California, if they find a utility company that may be responsible for some of these fires, they're paying settlements out to some people who've had property damage based on a fire. And so you may have a taxpayer client that actually receives more funds that they can prove that they've had a casualty loss. And those funds might actually be taxable to them. And so what this bill did in December is to say, if anybody anywhere in the US had gotten specifically wildfire release payments that exceeded their deductible loss or their substantiated loss, and it was any time in like the last dozen years or so, this went back a ways, that you now don't owe tax on it. And they actually permitted from December 12th, 24 to December either 11th or 12th, 25, you had an entire year from enactment of that bill to go back and amend if you had any clients that had paid tax on wildfire relief payments that were beyond the statute to amend when this bill came out. So we need to keep that in mind. Again, you may not be in an area that, and by the way, it was only wildfires, nothing else. But anyway, keep that in mind. And then there's also, this specific bill talked specifically about individuals. So then it became a question, well, what if somebody's Schedule C business got, for example, a settlement from PG&E, Pacific Gas and Electric in California? Would they have to pay tax? Well, again, we had to kind of like read the tea leaves and make a decision. And basically, individuals own Schedule Cs. So we're pretty much comfortable that if an individual got some wildfire relief payments, not an entity like an S corp or partnership, but an individual got those payments based on a sole proprietorship, it's probably tax-free and they can amend. Also, what if the individual was injured or deceased based on the wildfire? What about the payment made on that individual's behalf but paid to their trust or estate? So again, I have information about that in your handout, specifically about this very specific provision of this December 12th wildfire relief bill. And there's, they also had, and by the way, there's no double benefit. So even if some of the funds you may now amend and get back the taxes they paid on it, you can't raise the basis of any work you did, for example, on the property with those funds. And that's fair. The other comment I wanted to make is if you have any clients that were subject to that disaster of the train derailment right here, the East Palestine, they also made any payments from this disaster because settlements related to that disaster. And so people may have actually received funds that exceeded the loss that they could substantiate. So this also for federal purposes became tax-free for any clients that may have paid tax on reimbursements they got from the East Palestine, Ohio train derailment. So that's that one little bill that extended the dates and had a couple of tax-free provisions. So now what we want to talk about was when I mentioned the AGI issue is Tax Cuts and Jobs Act basically said the only deductible personal casualty losses are related to a disaster. And again, it's personal casualty losses. So let's say that, for example, a client of mine's a veterinarian and she had a huge plumbing problem and it flooded her whole clinic. That's her business. So if that was a rental property or even, let's say, a piece of land somebody's holding for investment, or in her case, it was her office, her business, she actually owns a building. But any disaster, whether it's a disaster or any other casualty loss, theft, anything, if it's related to a rental or a business or an investment, those are always deductible. They've always been deductible, and Tax Cuts and Jobs Act didn't change that. What Tax Cuts and Jobs Act said is, if someone steals my personal vehicle out of my driveway and my insurance reimbursement does not cover my cost of that vehicle, my basis in that vehicle, I may not deduct that. That's what Tax Cuts and Jobs Act did. It said if you have losses on personal assets, personal property, they're no longer deductible at all, no matter how substantial the loss is. And OBA has doubled down on that. Now, so let me give you an example of, and by the way, in addition to the fact that we can always deduct anything related to rental or business property, regardless of, somebody could steal your construction truck out of your driveway. If that's your construction truck for your construction business, or it's your little courier van for your tax business, whatever, that's always been deductible, even if it's just a theft out of your driveway. But we're talking personal casualty losses. And now, so here's where we kind of have to differentiate, what we're talking about. Oh, the comment I want to make, excuse me, is in addition to regular business losses or rental property losses, regardless of whether they're related to a disaster or not, there's also a provision for Schedule A in 4684 for anyone who loses money related to, for example, a Ponzi scheme. So if my new boyfriend that I have never met, okay, but I met him online, if he talks me into this great crypto scheme and I send him $50,000, that's a deductible casualty loss for me because I sent my new fiance 50 grand because I was going to make money on the investment he talked me into. But if my new fiance that I've never met tells me his mother needs $50,000 for her heart surgery and I send him $50,000, that's not deductible because I did not enter into the transaction of giving my new fiance 50 grand for the purpose of making money. I sent it to him because his mother needs medical care. So those deductions, anything related to a business investment, are still also deductible, okay? So what we're concentrating on here is our client that suffers a casualty loss from their personal assets, can they deduct it for federal purposes, and how much do they get to deduct? So I have a chart in your handout. Yeah, but example, storm damages 2 states. Okay, we have this chart in your handout. So I'm going to tell you the 5 levels of federal casualty loss for personal assets: home, car, boat, whatever. Let's say, for example, that my car, as I said, got stolen out of my driveway, in no way related to a disaster. And let's say that I actually had a very low basis in that car, and here comes the insurance funds, and I actually have a little gain. I have a little $2,000 gain. If I have any other loss, casualty loss that year, okay, and that's actually a loss, whether or not it's related to a disaster, I'm allowed to net that loss in the same calendar year to see if I don't have to pay tax on my $2,000 that I got that exceeded my basis in my personal vehicle that was stolen. So those types of personal casualty losses are deductible or able to net against a personal casualty gain for the year. That's the lowest level, and that's the second column right here where it says non-disaster losses. Okay. So that's number 1. I'm always allowed to net a gain against a loss in the same year, whether or not the loss is related to a disaster. So then here's where things get interesting. I'm going to stick with California. Let's say there is a huge storm forming on the West Coast, and it's gathering strength in Oregon on its way to California. And so let's say there's a fella just north of the California-Oregon border, and this huge storm knocks over a tree in his yard and completely destroys his roof. And let's say that the insurance proceeds he gets for this damage to his roof barely covered his costs, and he's got a huge loss, 20 grand, 30 grand. Because even though his roof was destroyed by the storm that was declared a disaster in California, it was not declared a disaster in Oregon. That is 100% not deductible for him in any way. He's got a $20,000, $30,000 problem on his roof, not deductible at all for federal purposes. Let's say his neighbor to the south, 10 miles away, but on the California side of the border, okay? And by the way, the one I just talked about, the Oregon roof, that is the column that says out of area disaster losses, okay? Now, we're getting into the first level, which is where it says federal casualty loss. Federal casualty loss, we're getting into our first level of federal casualty deduction. This is the form 4684 going to Schedule A. So someone on the California side of the border, same thing happens. Same storm, knocks over a tree, destroys his roof. However, he's in a state that now has a federal disaster declaration based on that storm, but it is not in his county, not in his zip code. So even though the same storm that will later be declared a disaster 500 miles to the south, he at least can take the lowest level of federal casualty disaster. He can file his form 4684. He is subject to 10% AGI, but he can take some deduction for his destroyed roof if he itemizes. That's the lowest level. The disaster was declared in his state, but not in his county or his zip code. The next highest level is where it says disaster loss. And by the way, where it says federal casualty loss, then disaster loss, then qualified disaster loss, those 3 titles are actually strict IRS verbiage, okay? So the second to highest level of disaster loss, this one's kind of interesting. Because remember how I said that any loss, whether it's related to a disaster or not, is deductible for a business or rental property. What's interesting about this next to the highest level one, it's still subject to the 10% AGI limitation, but you can choose to deduct it in the previous year if it benefits the taxpayer. And sometimes what happens, so if somebody's business, like think about those January fires in California, or even the Texas fires. If somebody's business got completely wiped out, their AGI or let's say you've got a taxpayer that just worked for a business that got completely wiped out and now he's on unemployment for 6 months or something. A lot of times the AGI, I shouldn't say AGI, oftentimes the tax bracket in the year before the disaster could be substantially higher than the year of the disaster. So what this second to highest level lets you do is say, I've quantified what my loss is for this disaster, fire, flood, whatever it is, storm, and I'm going to elect to take that deduction on my prior year's return and get am I going to free up funds immediately because I can file that amended return right now, but B, I may be at even double the tax rate for that year and get a much higher refund than I was expecting. Think about, for example, the January fires or the Texas floods. Those people, the January fires, they weren't going to file for more than a year. So even if they have a huge deductible loss for 25, they're not going to see 1 penny of that until they file their taxes a year later, right? More than a year, really. Who files in January? So the benefit of being able to deduct in the previous year is actually very favorable for a lot of clients. And what makes this even more favorable is any entity, partnership, S corporation, it's not just strictly for individuals. And so that if we have a business or a taxpayer that has suffered the disaster loss, then they're eligible to deduct it, the same loss in the prior year. Now you can't split it up, you can't take half this year, half like that, and you do need to, and we'll talk about this in a few minutes, you do need to be able to also have enough information to quantify your loss. And we'll talk about what that means. But this second disaster loss, okay, that we talked about is, so our fella in Oregon can't deduct anything. Our fella right inside the California border, he can take the lowest level, 10% AGI, but it's got to be the year of the loss. He takes the deduction. For this one, if you are in a county that has been declared eligible for FEMA aid, whether it's individual or public aid, you may now do the 2-year carryback. You're still subject to the 10% AGI, but you can do, and I shouldn't say 2-year carryback, you can do the prior year, deduct the loss in the prior year if it benefits the taxpayer. The highest, and by the way, you have to itemize. You can only take it if you itemize. The highest level of federal deductible disaster loss is totally dependent on what I said earlier about rolling these dates, okay? Where we've got to, in this case, we have to, I'm in the far column there under description, a major disaster declared by the president during the period, January 1, 20, and September 2nd, 25. So if there's a major disaster anywhere in the states that's declared September 3rd or later, they've got to itemize. They're subject to 10% AGI until they pass a new disaster bill. And it could be sometimes more than a year after the disaster, okay? And these dates I have over here are just the dates that are the applicable dates since OBA. There will be another disaster bill passed, but we don't know when. And when those new disaster bills get passed or they do what they did with OBA, slip it in another tax bill, then that would potentially benefit other people that have had disasters. But this is the critical part of how we wrangle this. And our new problem with OBA, like I said, is that highest level where you can ignore 10% AGI must be presidentially declared disaster. And by the way, this is not a blue state, red state thing. Sarah Huckabee Sanders loves Donald Trump. Donald Trump loves Sarah Huckabee Sanders, made her dad an ambassador somewhere. She asked him twice, very nicely, to declare Arkansas, and he wouldn't do it. The legislator in Arkansas made a formal request for a disaster they had after he was inaugurated. He wouldn't do it. This administration does not like FEMA. And so I think what we're going to need to do is we want to push more of the responsibility for managing disasters to the states. I think to be fair to the taxpayers that are affected, we're going to have to somehow change the verbiage of who gets to ignore 10% AGI. Is how I think that's going to ultimately shake out. So again, this little chart's in your handout. I'm not going to read through every line of it. But if you look at it where it says, subject to AGI, not applicable, yes, yes, no, like that. And by the way, the highest level where you can ignore the 10% AGI, that does have a one-time anything over $500. But by the time you get to ignore AGI, what's a $400 difference between $100 and $500? You're really solving for the no AGI. Think about all those California fires. Those were some very affluent neighborhoods where they had houses burned down. Some of those people make a couple $1 million a year. 10% of their AGI, $200 grand. It really substantially affected the amount of potential loss they could take. So let's talk about, so here's the 3 types of losses I talked about. And this verbiage, like I said, is right out of the IRS guidance. Federal casualty loss is the one where you're subject to the AGI, you have to itemize. The disaster loss, the second level, 10% AGI, you have to itemize, but you can carry it back a year. Qualified disaster loss, not subject to 10% AGI, you don't have to itemize. We're going to look at an example of that real quick. And you can also carry that one back the previous year if it benefits. Now, what we're looking for when we go to our little IRS website for under the disasters is a major disaster declaration, and that's actually in the tax code. It's got to be a major disaster declaration by the president. That is going to have a FEMA code DR. So it'll be DR and usually 4 numbers. Sometimes it'll say, like if it's Alabama, it would say AL-DR- and then 4 digits. So sometimes it'll specify the state. Now, we may also have a FEMA EM, emergency declaration. The EM would be the first and second federal deductible levels. EM would be the FEMA code. If you see a FEMA code FM, for F like Frank, FM, that is fire management, and that is not eligible for what we're talking about today. Now, I'm not going to read through these because this is basically what I've been talking about is the level of deduction. What I want to get over to is, and we did talk about this. I do want to remind you of this, but I've mentioned this already a couple times. The state-declared disasters will permit a federal casualty deduction, but you must itemize, and you are subject to the 10% AGI, unless we've got additional legislation related to that. I'll tell you what else the state disaster hurts, frankly. My state did this, California, and I don't think this is going to last very long. California has always piggybacked. If there was a disaster, California would come out and say, your postponement for filing, your postponement for funding an IRA, your postponement for your PTET election, whatever the federal permitted, we're permitting. California decided they don't like that, for Pete's sake. And so now California wants to have their own postponement dates. It's a big fiasco. And you actually now, if the California postponement for any disaster is less than the federal postponement, you've now got to file a form and prove that you've actually been damaged by a disaster to be able to use the federal postponement date. I don't think that's going to stand. But where these state-declared disasters is going to cause us pain as a practitioner is, we used to be able to just go right to the IRS disaster website and look at Texas, look at California, look at Hurricane Helene, whatever, wherever we found it, go right to the FEMA website and go, here's the FEMA declaration number, here's the incident period, here's the date it was declared, boom, I know it qualifies for this or this, right? Now that we can deduct some things that are only declared by an individual state and not by the federal government, now we've got to make sure, and a lot of us have clients that are not in our own state, right? So now we've got to go figure out, well, wait a minute, what about my mother-in-law that lives in Florida? I have to go figure out what she's eligible for the latest hurricane because that was only a governor-declared disaster, not a president-declared disaster. So this is definitely going to cause a little more work for us based on the federally declared. Again, these couple of slides, and this is in your handout, repeats what we talked about, whether there's assistance in the area, whether the disaster was declared in the state. So I'm not going to, and this, by the way, This is look at the last bullet point. This is right out of tax code. A major disaster declared by the president during the period between January 1, 20 and September 2nd, 25. So again, anything happened September 3rd or later, they're stuck with 10% AGI. The disaster must have an incident period that began before July 4th. Texas made it by 2 days. It must have ended no more than August 3rd. So these dates are critical when we're trying to figure out what someone's eligible for. What I have for us here is, and here I mentioned the numbers for us. So DR is the major disaster where we can ignore the 10% AGI. EM would be for all 3 levels potentially, would be for the first and second level of federal deduction. And FM we would ignore for tax purposes because that just means fire management. Now, and then I have this in your handout, which we've talked about a little bit, which is basically steps to determine the eligible tax treatment for a specific disaster event. So we'd go to the little IRS website and we'd find the incident, and then we'd click on the little FEMA link and we would find out, is it a DR or an EM? If it's a DR, now we're worried about dates, right? If it's an EM, we know we could at least potentially do the first or second level of deduction subject to the 10% AGI. And I have in your handout copies of these different web pages also. And here I'm talking about how we look up the incident period. And this is one of the websites. And you could just put in, the year you're looking for, or if you know the state. In other words, these websites are actually very easy to work with and manage and find what you're looking for. And again, I've got some of the sites in your handout. This, I just for fun put up 25, and there's just a list of the disasters that were announced since, I think, January of 25. And there's Texas, the top one. You can tell I did this a little while ago. But there's the Texas floods that we all heard about. And then see, the incident period, July 2nd. And then, remember I said that you can only do you could do the carry back to the previous year if they've been eligible for FEMA aid. When you click on the incident on the FEMA website, the shaded area on the FEMA website, and then if you look over at the far right, and this is in your handout, it talks about the shaded areas and whether it's eligible for public aid or individual aid. And that would tell us, the tax practitioner, for example, that taxpayer is eligible, for example, to do the 2-year carryback, for example. But look at somebody that would be in the white area. They may have sustained some disaster damage, but if they're not in the shaded area that got any FEMA aid, they wouldn't be able to take the loss in the previous year, potentially. So that's what we need to, and then I just have an example of the Texas storms. So what we want to talk about here is filing the tax return. And I'm trying to get over to our example of not itemizing. So here's what, goody, I found it. Okay, so what we want to do is, this is a qualified disaster loss, okay? So what we're going, and again, this is the far right-hand side of our chart. These are someone who, they don't have to itemize and they're not subject to the 10% AGI. So basically, they get their standard deduction plus they get their disaster loss. They get both. And we're going to actually file that on Schedule A. So if they qualify by the dates, okay, the qualified disaster loss, and they're not itemizing, we're still going to claim it on Schedule A, and we have an example of that. We're going to fill out our 4684, our casualty loss form, and then we're going to enter on the dotted line next to line 16 of Schedule A, standard deduction claimed with qualified disaster loss. And we're going to combine those two amounts. And we have a picture of it right here. What I did was just moved line 16 up underneath the title of Schedule A so we know where we are. So this is a federal 1040 Schedule A that just starts at line 15. And interestingly enough, look at the part highlighted in yellow. Casualty and theft loss from federally declared disaster other than a net qualified disaster loss, okay? So then it says on the next line, based on our instructions, net qualified disaster loss. So let's say this is just, let's say a younger taxpayer, and let's say his vehicle was destroyed, okay? So he's determined that his disaster loss from his vehicle being destroyed by the fire or the storm was $8,945. So that goes right there on line 16, and your software will let you input this. And then there's his standard deduction for 24, his 14.6. So his total Schedule A now is 23,545. And that taxpayer, because he met the dates for qualified disaster loss, that is his deduction with his loss and his standard deduction. And then, well, we also want to talk about the disaster year. We've already talked about you're eligible to deduct it in the previous year. The disaster year kind of becomes a thing. And here's where that may get a little bit painful. If you really want to talk about, like, if we contrast, for example, the Texas floods and the LA fires, there's an enormous amount of liability being thrown around about those LA fires. Was the water pressure sufficient? Was the fire clearing activity up to that fire adequate? Was there possibly any utilities that could be found at fault? So frankly, the lawsuits are still going in LA. And where I'm going with this is, technically, you're not supposed to file your tax return until you feel certain that you've recovered all funds to which you are eligible. So if you're involved in some of these class action lawsuits, you may not have it for a couple of years, for Pete's sake. And by the way, if you're not familiar with, what's the word I'm looking for? Protected claim. So if you've got a client that there's any chance that they've got some potential recoveries outside of maybe the statute for filing, for Pete's sake, you might consider filing now, whatever you can, maybe subject to the 10% AGR with the information you have now, but file a protected claim so that if and when the funds they are expecting to receive, maybe from a lawsuit or something, never materialize, you can still go back and perhaps save them some money on their taxes. But where I'm going with this is IRS. If a claim for reimbursement exists for which there is a reasonable prospect of recovery, no part of the loss for which the reimbursement may be received is sustained until it can be ascertained with reasonable certainty whether the taxpayer will be reimbursed. And what this does is it impacts the year that somebody gets to claim their loss. And so, for example, with the California fires, which happened like January 7th, for Pete's sake, chances are a lot of those taxpayers are going to know by the end of 25 what was their loss, right? They're going to know what they have recovered, and then they're also going to be aware, am I involved in any of these lawsuits that might carry over? But what if a disaster happens in October or November of some year? You're sitting there going, well, my house burned down, November 20th, but I may not have any idea until, much later next year of what I'm actually going to recover between my insurance company and the wildfire, trust fund payments and any claim against the utility company or the city of LA or whatever. And so now we have a problem, because now we have my house burned down in November. My actual tax loss year is the year I'm able to quantify my loss. So now my prior tax year I get to deduct is a low tax bracket year, because that was the year potentially my business burned down or my whatever. So in any event, we have to kind of keep our wits about us. And I will tell you that even though they say, you're not supposed to file until there's no substantial chance of recovery, honest to Pete, if my clients are having problems and we've gathered as much information as we possibly can, no one's going to jail by filing, and then you have to amend a little bit later and go, hey, they lost more than we thought they were going to. We're gonna now go back and amend and free up some more taxes potentially. But anyway, so just keep that in mind, that the year of loss can become challenging for the practitioner. Now, this is an IRS example, and again, it's December 23. Taxpayers' vehicles destroyed in severe flooding that occurred in the area where they live. Area designated by FEMA to be eligible for public or individual assistance, or both. They immediately filed a claim for reimbursement with the insurance company. There was a reasonable prospect that they would recover the full amount of the loss. The claim was settled in January 24, so basically a month, 2 months later, when the insurance company reimbursed only half of the loss. The disaster year is actually 24, not the year the truck was destroyed, which was 23. The loss is considered sustained in 24 because that's when it became reasonably certain they would be reimbursed. The taxpayer may either deduct the unreimbursed loss, the disaster year, the legal tax disaster year of 24, or make an election to deduct it the year the truck was actually destroyed, which was 23. And so this is a fairly simple example, but what if these are bigger numbers? What if it's like, for example, a huge business or something? And again, what if the tax bracket is double? Or some of these are going to be very challenging things to kind of advise people on and wrangle and do tax planning for potentially. So those are the two biggest issues I want to make sure we were aware, was the 10% AGI and the taking the deduction for people that don't itemize. And then, again, we've got some information here about claiming the loss in the year of loss or the preceding year. And I've got a couple of slides. Okay, and then also how we deducted on the 4684. Are there any questions for me in the group? Okay, and then what you're going to find is there is an enormous amount of work to do to just quantify somebody's loss. What is their basis in their property that got destroyed? What did they actually recover? Are some of the funds they recovered supposed to be for like living expenses while they're being displaced? Is all of that actually tax-free? So there's a whole bunch of work around just quantifying what is someone's deductible loss. So what we have in our handout is a lot of different examples. So one example I'm going to give you is, let's say the only thing that happened to a taxpayer's home is that this enormous tree they have got blown over. Okay, this enormous, gorgeous tree that if you were going to go buy it at a nursery would be $500, $1,000, this gigantic tree. The tree didn't hurt the house, nothing happened. So that taxpayer technically does not have a $500 or $1,000 loss. Aside from the fact that it would be subject to the AGI anyway and the $100 little casualty deduction. But if the fair market value of their house has not been reduced by the fact that they're missing a big tree, they don't really have a deductible loss. The only thing technically they have as deductible is if they have to pay someone to come saw up the tree and haul it away perhaps, they're out of pocket that amount. But the mere fact that they lost something that if they wanted to replace it would cost X, if the fair market value of their property hasn't reduced by X, they don't have a tax deductible loss. So we've got this kind of information in your handout because that would be a whole other, frankly, 2-hour session of how you just quantify these losses. There's other information in your handout about, for example, what do you do if someone's in a condominium, right? So the portion of the residence that they actually own got damaged that they're responsible for, but how do we quantify, are they eligible to take any disaster losses for perhaps damage to the common areas in something like a condominium complex? And there are a great deal also of, for example, IRS examples that walk through these and the different methods you can use to quantify what they call repair costs or replacement costs or those kind of things. So again, that would be a whole 2-hour presentation of just how you do the math on those. And today what we were trying to really concentrate on, especially since we only had an hour, was to talk about how we figure out not only what level of deduction somebody was eligible for, but also whether they're subject to the AGI. Now, and then, by the way, we do have a disaster pub 547. The last time I looked at this has not been updated yet for OBA to talk about the state declared disasters yet. But what I was talking about the qualified disaster and the applicable dates based on the last tax bill and all that, that information is in that pub 547, assuming it's been updated. And I would also, oops, did I go too far? I want to talk about also amended returns. They did talk about, and in the IRS example, they used Helene hurricane. They do say that to the extent that they can identify To the extent that they can identify an amended return that is specifically related to a disaster claim for refund, that they will process those ahead of others. They're actually recommending that you put the disaster in the margin on top of the 1040. I think that, because you can e-file, right? You can e-file amended returns now. And by the way, I don't know if you know this. When you e-file an amended return, it's processed as a PDF. When you e-file a 1040, it's actually processed as code. You know, line 7, this dollar amount. But when you e-file a 1040X, it gives you a level of comfort that they got it, okay? But they're still processing amended returns at the Internal Revenue Service as a PDF. They're not processed like an original 1040. But their point is that if you identify it as related to a disaster and you name the disaster, that it will go to the top of the stack of amended returns. And they claim, of course, this was published before shutdown, that their time frame was generally about 60 days for an amended return related to a disaster loss. So you might think about if somebody's really hurting financially and is hoping to free up some funds based on a disaster, maybe filing that 1040X on paper and identifying as a disaster. Here's some of the sites we have. And then occasionally you'll see IRS guidance where if there's been substantial areas with disaster postponements, they'll put out a notice reminding everybody their postponement's almost up. And then, this notice that came out in January, the entire states of Louisiana, Vermont, and all of Puerto Rico and the Virgin Islands, and then they go list parts of all these other states, have until February 3rd to file their 23 returns, okay? And that was February 3rd, 25. So those are the types of postponements and reminder notices we might get. And then okay, and here's our FEMA website and some IRS site, and then also we do have IRS FAQs. I looked at those today. I don't think they've been updated. What I'm trying to get to, here we go. Okay, here we go. Other topics in our handout. So this is one of my last couple slides where I just kind of list the other things I have in the handout. For example, if your office is in a disaster area, does your taxpayer get the postponement related to your office, even if your taxpayer is, for example, in another state? And by the way, the answer is yes. The other thing is, if you've got a taxpayer that's just waiting for a K-1 from a partnership or an S-corp that's in a disaster area, even if that taxpayer is nowhere near a disaster area, if they're waiting for a K-1, they automatically get a postponement. And I have some information in your handout about how easy it is to get their account flagged that they're eligible for postponement, even though their mailing address is not affiliated with a known disaster area. Okie dokie. So I hope this helped everybody. And thank you very much for inviting me to speak.